Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So of course, we're going to be writing or selling options contracts. Those terms are interchangeable, so we need to know where we are in the option cycle. So you want to open up your brokerage platform. The one I use is Tasty Trade. You can use whatever you like, and you want to just pull up a list of expirations on something like Apple, just a standard equity, and we can see we've got a list of expirations here. Now we've got two types of expirations: weeklies and monthlies. So an orange W shows that it's a weekly. If it doesn't have an orange W, then it's a monthly. So which strikes are we going to pick? Which expiration dates are we going to pick? We want to be about 45 days out in time. Anywhere between 30 and 60 days will do. And we want to be on a monthly expiration. So the next expiration, monthly expiration, is October 18th, 10 days away. That is far too short. So we're going to go to the next one down, which is November 15th. That's 38 days out in time, and that is much more suitable for what we need to do. So now we have this information of 38 days out in time. We can come over to our watch list and we can simply filter out any underlying that has earnings over the next 38 days. The reason for this is because we do not want to be in the position whilst earnings is going on, because it will almost certainly increase volatility and mess up your deltas, and both of these things are going to have a negative effect on your P&L. So we want to stay away from that, and we also want to filter out anything that has a low liquidity level. The reason for this is we only want to trade things with high liquidity, and that's going to give us tight spreads, and it's going to allow us to get in and out of positions relatively easily. So now, once you've done that, what's left here is a list of underlyings that don't have earnings and are very liquid to trade. Finally, you need to sort everything from high IVR to low IVR. And the reason for this is because we want to sell when volatility is high and play the contraction back down to the mean, and hopefully even further below, because volatility is a mean reverting thing. So now we've got our watch list all set up. The only thing that's left to do is simply go down the list and see what takes our fancy. Before we do that, if you have got positions in your portfolio already, just keep in mind what positions you have got on. If you are heavy in any one sector, obviously just make a conscious effort to try and be as diverse as possible, and that will help your returns, the consistency of your returns as well. So straight away at the top, we've got EEM, we've got crude oil, we have got a position on MCL. So we're going to stay away from crude oil, but it does have a nice IV rank. GDXJ, GLD, FXI, Baidu, JD. It's nice to see that Baidu, JD, Baba, their IV ranks have come right the way down. They were sitting at over 100 for quite a while, and we did make some videos, quite a few videos, highlighting the opportunity here with these Chinese stocks. And if you did get in on any of those positions, you would have played the volatility contraction, and you would most likely be in a very healthy profit at this point. So let's just go back to our watch list. At the top here, we've got EEM. It's an emerging markets ETF. It has got the highest IV rank of 93.1, and it's also an ETF. Whenever you can trade an ETF and still get paid a good amount for it, I would always recommend that over trading a company, because when you trade an ETF, you eliminate company risk, and it's just one less thing to worry about, and it will have a positive effect on your P&L over the long term, and it will help with smoothing your P&L out as well. So EEM looks fairly decent. We've got 4 out of 4 stars on the liquidity rating. Most ETFs usually are pretty liquid. We've got a correlation to the SPY of 0.72. And we've got an IV rank of 93.1. It's currently trading at about $46. So it almost certainly won't require much buying power. So it'll probably be suitable for most accounts. So let's have a look at EEM. We already know we're going to be 38 days out, November 15th. And we can, once we open up this expiration date, we can see we're presented here with the options chain. The orange horizontal line shows you where price of EEM currently is with respect to the other strikes, and the orange vertical bar shows you what the expected move of EEM is over the next 38 days. So what do we do here? How do we make money out of this, of what's in front of us? So we need to sell something. We need to sell some contracts. So what contracts are we going to sell, and where are we going to sell them? There's two types of contracts: calls and puts. Very simply, we're going to sell one call and one put. Where are we going to sell them? Well, we want to sell them outside of this expected move because we want our contracts to expire worthless, or at the very least, we want to be able to buy them back for less than what we sold them for. So we want to be outside of this expected move, and I typically like to go anywhere between a 15 and 20 delta. So if you go down the delta column on the call side, as we can see, we've got a 17 delta here at the 50 strike. And then if we go down the delta column on the put side, we've got a 16 delta here at the 42.5 strike. So we've created a range here at 42.5 and 50. And as we can see, our strikes, our contracts here are outside of the expected move. And this is going to lead to a high probability of success on this trade. And we can see that in the bottom left corner here, we've got a probability of profit of 73%. And if we wanted to get out of this position at 50% of max profit, we've got an 87% chance of that happening. So this is a very high probability trade that we're looking at here. So if we were to just plot this on the chart so you can visually see what this looks like, our price levels would be 42.5 and 50. So if we just go to 42.5 and 50 is just up here, about there. Perfect. So 42.5 and 50, this is the range that we've essentially created for ourselves. As we can see here, implied volatility rank is increasing, which is perfect for us. And as long as price stays within this range, we'll be just fine. And hopefully we can see a little bit of a contraction in volatility as well. So what's happening here? Price is currently at $46.13. Our call contract is up here at 50. Our put contract is down there at 42.5. We want price to stay within this range, and specifically we want price to be within this range at the point of expiration on these contracts, which is exactly 38 days away. And if that happens, we keep 100% of the premium that we collect up front. Now, what is the premium that we collect up front? That is what this number is down here, 0.66. That is 66 cents to be exact per share, and there's 100 shares per contract. So that's $66 in premium that we would collect up front. Now, our broker is going to require $560 in buying power to open this position. So it's not the greatest return on capital compared to, say, something like a covered position. However, you do have the benefit of having a very high probability of profit. You can, of course, always buy another contract a little bit further out if you wanted to. Let's say a dollar out. I wouldn't recommend it necessarily for this position because it doesn't require much buying power in the first place. But just to make the point, you can just buy another contract a little bit further out, the same width apart on both sides, and it's going to reduce the amount of buying power that's required. It is going to reduce the premium that you collect, but it will also reduce the buying power that's required. It will reduce your probability of success as well. It will reduce your daily theta decay, but again, you do get a higher return on capital, and that's essentially the trade-off when it comes to covering your positions. Now, for this specific position, I wouldn't recommend covering it because it does only require about $560 in buying power. So if you can and you want to, by all means, this is a nice naked position. We do have an unlimited max loss potential. That's why our buying power is higher when it's naked as compared to covered. However, If you look at some of our recent videos, we've shown you how you can actually manage this risk and what to do when positions go wrong and what to do when they go against you. Naked positions are actually much easier to manage than covered positions, in my humble opinion. So with that being said, this is how you find positions and how you can manipulate positions to fit your portfolio. There is also one other thing you do need to keep in mind, and that is the size of your positions, because it doesn't matter what you know, it doesn't matter what you do. If the sizing of your positions are wrong, then eventually it won't. Eventually, something bad will happen, basically. So the way that this position sizing template works is free, first of all, for everyone to use. You can just put in the size of your portfolio. Let's say if it's $7,500. Below that, you can then enter in the whatever the current VIX level is. Let's just say if it's 14.2, everything below will automatically be calculated for you. At this point, all you need to do is use the information here to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow everything here, you'll be absolutely fine. This is free for everyone to get a copy of. If you do want a copy, click the link in the description and head over to the free position sizing template. It will take you to wherever you need to go. And if you want to get involved on the positions that we're placing in our portfolios and you want to make money with us, again, click the link in the description, head over to EDS Premium, get yourself signed up. And once you're in, you will have access to our portfolios and all of our trades in real time. So you can copy them and you mix and match and see whatever you want to add into your portfolio. Based on whatever size your portfolio is. There's also a full course, so no prior knowledge is required. We will teach you everything you need to know. It allows you to learn and earn at the same time. It is a private community, so if you do get stuck, by all means, you can just speak to myself directly or speak with other like-minded individuals. And there's also a 100% money back guarantee. So if you studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now, it's £1 a month. The price will be increasing. However, once you're in, you don't need to worry about price increases. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.